Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Nancy Lazar, the chief global economist at Piper Sandler, is bracing for a soft employment report on Friday. She joins us now for more. Nancy, good morning.
Good morning.
What's a soft employment report on Friday?
Well, we're assuming about 80,000. That's maybe a little bit more than consensus, but as of now, 80 is our best.
Isn't 80 good these days?
Probably 80 is better than something closer to zero, to be sure. But it is a very, very clear shift down, and you see it in a lot of data. Companies aren't hiring. You see that in continuing claims. They're not firing aggressively. Initial claims are still relatively low. Your point earlier on the quit rate. The quit rate is coming down. People are reluctant to leave. And just ask consumers. I mean, the Conference Board survey of is it hard to get a job or is it easy to get a job is a metric I've used my entire career. And consumers say it is hard to get a job. So there's clearly been a shift down in the labor market. Why? Companies are trying to protect their profit margins.
Is 80,000 an even worse number because of the downward revisions? Yeah. To Mike's point, that the longer you wait, the more unclear the data is in the short run, but longer term, you do get just as clear of a look in terms of responses.
So the household employment data, which comes out with the unemployment rate, actually historically at turning points is better than payroll. I've studied this again my entire career. It was first written about in the 1970s. Unlike payroll, the household employment data aren't revised. There's a once-a-year population adjustment, but you can smooth that out. There's been no growth in the household employment survey for the past 12 months. And then next Tuesday, you're going to see the QCEW, the quarterly census of employment and wages. And that's going to likely show a very sharp reduction in payroll from March of 25 back over the past year of about at least 800,000. That is, payroll is going to start to look more like the household data. Consumers know it's a weak job market. They're cutting back on highly cyclical stuff, both on the goods side and on the service side. So the idea that you're getting new news from the payroll report to me is a little misleading. Consumers have already reacted to this weak employment backdrop.
When does this turn become a problem? Because it's not a downturn. It's not a downturn yet. And it doesn't seem to be heading toward any kind of recession. But this low hire, low fire dynamic has continued, and people don't feel very good. But companies are doing just fine, as we see in the earnings. So when does this become a problem?
So that's so important that companies are doing well in this environment. Before you can see an upturn in the job market, companies have to make money. That's been a beauty of the U.S. economy over the past decades, that companies are allowed to stop hiring and or in some cases fire people so they can rebuild their profitability, and that then gives them the ability to hire people. So I think some of the most bullish news for employment in 26 is the fact that 2Q S&P earnings came in double what they were supposed to have been and hit a record high. Prior to every upturn in employment growth, you first need an upturn in earnings and profits, and we're seeing it. So kudos to American companies.
Is that what you're forecasting now? A rebound in economic activity?
We are. This year, you're 1.5%, but you're already seeing capital spending turn up. Individual companies are seeing it. You saw it in the new order data yesterday. Why is that happening? Well, the Fed cut rates 100 basis points a year ago, and it takes about a year for that to work through the system. Second, you do have this full capex depreciation, which is the most significant capital spending booster shot since Reagan in the early 80s. You're seeing it in company data. So we have 3% GDP growth next year, and we don't think 3 is the new 2. We think next year inflation does shift back down to 2%. You'll lap the tariff increases, and you'll also see further acceleration in productivity, slowing unit
That's a great
costs.
setup. You're looking for 3% GDP, 2% inflation. Where's the Fed in all of that?
We don't need an aggressive Fed in this cycle.
You might get one.
That would make me worried about inflation in the back half of 26. You have stronger potential GDP growth, which is about 2.5%. Fed funds are pretty much in line with that. Nominal GDP growth of about 5%. Fed funds are a little bit lower than that. The problems of the 70s happened because the Fed would shove rates down way below nominal growth, creating a boom and then eventual bust cycle. And so we think maybe one cut would be healthy. But more than that, I would then start to worry about inflation.
Okay, let's take a beat. Nancy, new Fed chair comes along. Huge selection process. And they're going to deliver one cut in 2026.
Again, if the economy is if you go back and look at the 90s, which is where we think there are echoes of the 90s, the tech obviously strength in the 1990s. Greenspan in 95, I believe, cut rates just once, and you had 3.5% GDP growth with inflation slowing. You didn't need a lower interest rate environment because you had healthy potential GDP growth, stronger productivity growth, and very strong corporate profits, and those were the things that were driving growth, not lower interest rates. Again, that creates problems like another house price bubble and or a boom in nominal GDP growth, which then opens the door to inflation.
How has artificial intelligence changed the nature of that rebound, given the fact that this isn't necessarily going to be a job-full recovery that can be equally distributed to a lot of different people in different sectors? So
under the hood, there's always creative destruction in the employment data. Just look at the retail data when Amazon came on in the 1990s. You decimated retail employment in certain sectors, online touched sectors in particular. But at the end of the day, overall retail employment rose. And so creative destruction within the job market has gone on, not just back in the early 1900s, but even over the past 10, 20 years. Tech employment has not been a driver of the employment cycle. So I view AI as more of a productivity-enhancing, profit-boosting mechanism that actually is going to create more jobs because companies are going to have stronger earnings.
You're using it, and you love the Beige Book.
Yeah.
Can you tell us what you're doing that you think actually how it affects your job?
Well, for us, my colleagues are very talented, and using ChatGPT-5, you can actually write code for the Beige Book and get a sense of what the direction of the economy is from AI. So I'm a product of technological innovation. I started with a typewriter, obviously, then I went to a computer, et cetera. I'll stop. But technological innovation in this industry is not new. It just improves our ability to do, but hopefully, not always, a better economic outlook.
Stay with us. More Bloomberg surveillance coming up after this. Mark Cabana, the head of US rate strategy at Bank of America Global Research, is with us around the table for more. Mark, good morning.
Good morning.
It's good to see you.
Likewise.
A lot's changed. What's changed for you?
So we think that investors should really be focused on where the cutting trough in this cycle is. That's still around 3%. The Fed thinks 3% is neutral. The market seems to believe that that's credible and that the Fed will head there. Increasingly, at least for our rate strategy team, we see 3% as almost a cutting ceiling. They're going to at least cut to there, we think. And we think that the market is not fully appreciating the potential range of outcomes below 3% that the Fed could take us to. And that range of outcomes, we think, exists because you do have a moderating labor market. You do have inflation that is expected to peak around the end of this year or first half of next year. But we also think that you're going to have a composition of individuals at the Fed that are going to be targeting potentially different objectives than the current Fed is. And specifically what I mean by that is, think about, let's say, how the Fed judges the natural rate of unemployment. The Fed thinks that in the longer run, this level is 4.2%. They don't know that for sure, but that's their estimate. What's to stop a new composition of Fed officials from targeting a potential 3.5% or sub 4% type of natural rate of unemployment? And we think that you're going to increasingly hear these types of arguments from individuals that are being considered to adopt leadership positions at the Fed. I'll certainly be listening for that on Thursday with Myron's testimony, because we have heard from other, let's say, Fed chair contenders that they're open to this idea. And if the Fed does indeed adopt that type of approach, that opens up the range of outcomes for where the funds rate can go, well below 3%. We think you want to be received 5-year OIS to benefit from that. It also means that you should be expecting that longer run inflation expectations move up, because they are still very well anchored. We agree with the Fed's assessment on that. We think that they can be moving up. We think that the inflation curve can be steepening. And we think that the nominal curve should also be steepening in that type of environment. Finally, we like being short 30-year asset swap spreads because we do worry about some of this supply-demand dynamic at the back end of the rates curve. If the Fed is, let's say, cutting to rates lower than what many of us would think are justified by fundamentals today, who's going to buy the bond? If you're worried about upside inflation risks and the deficit is still not improving materially, who's going to take down all that long duration treasury supply? So we think you want to be positioned for that. And we like being short 30-year asset swap spreads to do so.
So as you talk, I'm thinking I'm going to hide in gold. I'm going to hide in the most pro-growth stocks because essentially they're going to juice everything. I mean, essentially, isn't what you're saying really positive for stocks, really positive for gold, terrible for the dollar, and don't even touch that 30-year bond?
Yes.
Okay, so that's basically what you're looking for right now.
And we just think that, again, you can focus on fundamentals. And fundamentals and our economists, and kudos to them, are still very much rooted in that. They're thinking this is an economy that's not headed into a recession, where you've got stagflationary risks, where inflation is going to be 3% or higher by the end of the year, and where the Fed is running the risk of a policy mistake by cutting later this year, if that's indeed what they do. And so they're thinking, why would the Fed be doing this? And I understand that from a fundamental perspective. But we've all seen the headlines. We've all seen, at least, or we've heard some of the approaches that individuals who are being nominated or considered for Fed leadership positions are espousing. And all of those, at least to me as a rate strategist, say, why are they going to stop at 3? Why would they do that? Waller is just saying, no, we're going to cut to neutral, or I think we should be heading to neutral, and I think neutral is 3%, but he'll be the first to tell you that he doesn't know where neutral is. And then once you start to contemplate some of these other arguments, we suspect, about lower natural rate of unemployment and really strong GDP and deficit financing levels, which is not in the Fed's mandate, but certainly you hear that line of argument from administration officials. Once that creeps into the dialogue, then why would they be stopping at 3? So we just think, again, that the distribution of rate outcomes is much greater to the downside than what the market is currently pricing, not necessarily due to fundamentals, but due to a shift in the approach for how the Fed will likely be thinking about setting monetary policy.
You know, I give you a lot of credit for trying to force people to think outside a conventional framework, because I think that what we could see next year could be very unconventional.
The idea of targeting something sub 4.2% on the jobs market and ignoring the inflation possibility. I'm just thinking, I mean, I understand why people are pro-risk in that environment, because why wouldn't you be pro-risk at a time where they're trying to juice growth at the expense potentially of inflation?
No, we've got to run.
I do
We're
think
against the clock. 15, 20 seconds.
Okay, so what stops this? We think two things stop this. Number one, popular discontent with inflation, the voter. But I don't know about you. I would imagine that it takes above 3% inflation to really bring individuals out to the ballot box on this issue. 5. Or 2, loss of control on the back end. And you're going to be looking at best in cutting auction sizes in that event, or potentially the Fed using the balance sheet.
Stay with us. More Bloomberg surveillance coming up after this. With us here in New York, Libby Cantrill of PIMCO. Libby, good morning.
Good morning.
September 17th. Will she be there?
Will Lisa Cook be there? I mean, we think so. We expect so. I mean, I think obviously this is how the court will adjudicate this, is sort of anyone's question. But assuming that the court has not sort of definitively decided whether this is fraud, we believe that she will most likely be there. I think the bigger question in some ways is, will the Council of Economic Advisors Chairman Myron be there? He, of course, is going to be sitting for his Senate confirmation hearing tomorrow. we think that is quite aggressive. So Lisa Cook most likely will be there, again, sort of barring any sort of court developments, but Chairman Myron probably will not be there.
How much is it going to be a contentious fight with Stephen Myron in those hearings tomorrow versus just paving the way? Come on down.
Yeah, well, I think we've talked about this before. I mean, the Senate confirmation process is not necessarily perfunctory. I think the market sort of just assumes that whomever any president nominates, they'll likely get confirmed. And I think for in most cases that is true. But for this particular position in this particular context, we do think that any sort of Fed nominee is going to be really questioned by Democrats, of course, but also by Republicans. And remember that the first step towards Senate confirmation is through the Senate Banking Committee. And, that again might just sort of seem like a bunch of kind of mumbo jumbo, but it's actually very important because assuming no Democrats vote for, say, Chairman Myron for Fed governor, that means that he cannot lose even one Republican vote in order to advance to the full Senate floor. So tomorrow will be very, very important. We do expect that he will get confirmed, but again, probably not in this very accelerated time frame, meaning that he'll probably, the earliest he'll be seated for the FOMC is probably October.
The controversy over the Fed has sucked up a lot of oxygen and a lot of time, and I wonder how much we ought to be putting to the idea that we could be facing a government shutdown in a couple of days, and I will say, or a couple of weeks. And I say this at a time where globally we're talking about government dysfunction, how much it could be affecting some of the fiscal worries in markets. Are you expecting us to actually shut down again? I mean, is this actually a worry that we have to focus on?
Well, I think that the market is pretty desensitized because there have been so many head fakes around government shutdowns, around debt ceiling fights. And so I think it's sort of understandable that the market sort of inured to even this discussion. But we do think the risk for a shutdown is higher this time around than it has been in probably several years. And that's because just the friction between the Republicans and the Democrats, the requirement, remember, that in order to fund the government, you need at least 60 votes in the Senate. That, by definition, will require some Democratic cooperation in the Senate. You may even need Democratic cooperation in the House as well. And just given that lack of comity, that friction, maybe an understatement, I do think that the Democrats may very well be willing to take the political risk and shut down the government. Now, what we've seen from an economic perspective, it doesn't really matter unless it is a prolonged shutdown. But again, I don't think the risk of that is necessarily zero, just given some of these sort of political dynamics.
The issue we've been talking about in the last 24 hours is very much close to home for you. It's in the bond market for the team over at PIMCO. What's been amazing for Lisa, me and others on this programme is to see tariffs go from something that was bond negative in April to bond positive as we kick off September. How are you and the team thinking about that now? Yeah, well, and I think actually in all of these things that we just were talking about too, I mean, from our perspective, really lead to what we've seen in the bond market, which is a curve steepening kind of bias. And that is something that we've been positioned for that really since the beginning of this year. Clearly, there might be even more room to run on this in terms of the concerns around Fed independence, the concerns around inflation, the concerns about a government shutdown. We think that all reinforces at least a steepening bias. But yeah, I mean, I think, again, this is the kind of where we think this is sort of our sweet spot in terms of being active managers, being able to find some value in the bond market. But again, all of these things that we speak up in terms of Washington really do reinforce this idea of a bond steepening. How much revenue are they raising through tariffs at the moment? Well, a lot. I mean, it's, to date, it's around, for fiscal year, it's around $150 billion. So there is, of course, a question of whether the government would have to return that money. I think that is an open question. Our view here is that this legal process that you all have been talking about will play itself out, will likely go to the Supreme Court. If that is adjudicated on a sort of a normal time frame, that means that we may not see a ruling until actually June of 2026. So the upshot for the market here is, even though there's a lot of noise back and forth around these tariffs, our expectation is that they stay on, at least in some form or fashion, for the foreseeable future. And then, of course, as we've talked about, John, before, the president has a lot of other tools. So if the Supreme Court decides in an expedited fashion that he cannot do this, we think that he will put tariffs on using some of these other levers that he has. Stay with us. More Bloomberg surveillance coming up after this. Let's turn to the consumer. Kate McShane, a US retail analyst at Goldman Sachs, writing this: we have seen growing concerns around the health of the US consumer. However, we expect a combination of job growth, easing interest rates, and more benign essential spending to translate into resilient spending power. Kate joins us now for more. Kate, welcome to the program. Let's just build on your outlook. We've seen a market start to believe in a pickup in this economy. Are you hearing the same thing from the companies you follow?
I think we are. I think there is some hesitation going into the back half of the year in terms of what some of the higher prices we could see as a result of tariffs could mean for the consumer. But as we enter into 2026, and we published on this yesterday, we do expect to see an accelerating cash flow for the consumer, especially with that middle income consumer.
How much, Kate, has the expansion or the rosier outlooks from the retailers come from the idea of more robust demand from consumers, and how much has come from the fact that they can raise prices and cut staff or cut costs around the corners and maybe deploy a little AI, deploy a little something else?
I do think there is a strong underlying demand that's underpinning the sales that we're hearing and seeing from retailers. What we've heard for the last couple of years is that while the consumer is being choiceful, they do respond to newness and to innovation. And we've heard so far that back to school has been very strong as well. And back to school is usually a very good future indicator for how holiday will turn out. And so I do think that there is a fairly healthy consumer that is underpinning the demand for these discretionary sales.
How much, Kate, is this affected by some of the uncertainty that we've seen? There was this expectation that heading into the end of the year, there would be more certainty around policy, more certainty about, what was coming down the pike. And now we have the question about the legality of some of the tariffs. We have questions around what is going to happen with the budget deficit, a government shutdown. I mean, is that basically not on the minds of a lot of the executives that you're talking to there?
Oh, I think the uncertainty is definitely something all of our companies that we cover have spoken to. I think there is a lot of uncertainty in terms of how things will play out, again, in the back half of the year. I don't think we've seen as much fear from the consumer, though. We haven't heard as much of pull forward in anticipation of potentially higher prices in the back half of the year. Everything seems somewhat normal when it comes to the consumer pattern of spending.
Kate, I want to just ask, we've been talking all morning about the proliferation of artificial intelligence and how a number of different companies are using it and how it is migrating from the Magnificent Seven to the rest of the names in the index and beyond. Are you hearing about tangible ways that retailers are using the latest technology to either facilitate sales, reduce costs, or even just improve processes?
Yes, I would say within the last couple of quarters, we have definitely seen the narrative around AI accelerate in terms of how these companies are thinking about the future. We do hear it in the context of efficiency, I think a little bit more than anything else. Think supply chain, think e-commerce and product descriptions. There's a lot of things that they're talking about kind of early on here, but I think we're going to hear a lot more in the next couple of quarters of, again, how it's improving efficiency at all these companies.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.